Today, economic chickens and housing risks are coming home to roost. Hello again, it's Martin North from Digital Finance Analytics. We've noticed posts covering finance and prop news with a distinctively Australian flavour. Well, the Australian retail turnover rose 0.2% in June 2022 to another record level, according to the retail trade figures released today by the ABS. The June result followed a revised 0.7% rise in May, a rise of 0.9% in April, and a rise of 1.6% in March. So you can see that the rate of increase is declining. And of course, a lot of this is going to be driven by inflation putting prices up. You're just paying more for the same things. The ABS said while the 0.2% rise in June was the sixth straight rise in retail turnover, it was also the smallest by far this year. Results were mixed across the six industries, with turnover rising in three of them and falling in the others, as cost of living pressure appeared to be slowing the growth in spending, they said. Cafes, restaurants and takeaway food services had the largest rise, up 2.7%, followed by clothing, footwear and personal accessories retailing at 1.3% and other retailing at 0.5%. Department stores saw the largest fall, down 3.7%, followed by food retailing down 0.3% and household goods retailing down 0.3%. Turnover rose in the Northern Territory up 1.8%, Queensland up 0.7%, the ACT up 0.6%, Western Australia at 0.5% and Tasmania at 0.5%. But New South Wales was the only state or territory where turnover fell, down 0.2%. Retail turnover was relatively unchanged in South Australia and Victoria. Given the increases in prices we've seen in the Consumer Price Index, it will also be important to look at changes in the volumes of retail goods in next week's release of quarterly data, the ABS said to Wright. Now, also today, Treasurer Jim Chalmers came to the Parliament and presented a more realistic view of where the Australian economy is going. He also referenced the recent IMF report, which I discussed yesterday, which is, of course, forecasting weaker growth. He said first inflation is now expected to hit 7.75% before easing back to 5.5% in 2022-3 and 3.5% in 2023-4. Now that's higher than the RBA was showing and is more elevated, and it will also be more elevated for longer. Now that's well above the RBA target, of course, for core inflation of between 2 and 3%. And Treasury's forecast under the previous government was 4.25%. So their track record continues to be pretty bad. Cost of living will continue to rise, and real income growth for most will be a pipe dream for at least the next couple of years. They forecast 3.25%, moving to 3.5% next year and 4% the year after. But given past performance, I think we can write off real income growth for many. In the year to March, real wages fell 0.7%. That's the worst result for more than 2 decades, Chalmers said. And he went on to say we don't have an inflation problem because workers are earning too much or because we're in some kind of wage price spiral. Real wages growth over the past decade has averaged just 0.1% a year. As rates and the cost of living go up, economic growth is expected to be weaker, with Australians tightening their belts and not spending as much. So GDP has been down forecast to 3.75% this year. That's down from 4.25%, 3% next year and 2% the year after. Given the input variables, I also take this with a big pinch of hopium because Treasury modelling tends to extrapolate from the current trends with tweaks and cannot hope to account for significant disruption or dislocation. Just look at their attempts through COVID. Jim Chalmers said that the budget that the government inherited was, quote, booby-trapped by expiring measures. He says COVID spending has so far cost the budget $1.6 billion this year alone. We expect that government payments will be around $30 billion higher than were forecast pre-election because of inflation and wage expectations and how they flow through, Chalmers said. And finally, here is a disturbing story reported by the ABC when APRA warned the Albanese government about heightened housing risks as interest rates rise. They say the banking regulator warned the incoming Albanese government that it could face heightened risks in the housing market as interest rates rise. The warning came in the incoming government brief prepared for the new Labour government when it took office in May, and it was made public as a result of a Freedom of Information request by the Australian Financial Review. The 48-page document laid out a range of issues that APRA was looking at across the banking, insurance and superannuation industries it regulates, but housing was front and centre. A sustained period of record low interest rates has seen strong growth in housing prices in recent years, and this has been high relative to advanced economies globally. Household debt levels relative to income are also elevated both historically and internationally. Even though interest rates had only just started to rise in May, when the report was written, APRA cautioned that more expensive mortgages would put some borrowers into financial trouble. Well. The faster-than-expected emergence of inflationary pressures and a rising interest rate environment is likely to place some strain on household balance sheets and place a number of households in financial distress, it noted. Finally, they're singing my tune. Low interest rates have in aggregate assisted borrowers in building substantial mortgage repayment buffers. Nevertheless, a number will experience loan repayment shocks, particularly those on very low fixed rates, as interest rates increase. More generally, high interest rates will reduce borrowing capacity, increasing the likelihood of a decline in Australian housing prices. The sentence after this, by the way, was redacted from the FOI because it was either an opinion, a recommendation or advice, or because it was part of a deliberate process. APRA warned that high interest rates will reduce borrowing capacity, increasing the likelihood of a decline in housing prices. And recent CoreLogic figures show Sydney home prices falling close to 2% over the past month, with prices in Melbourne also declining sharply and slowdowns emerging across the other major cities. Many economists, including those at the major banks, are now forecasting peak-to-trough falls of more than 15% for home prices nationally, with some warning of the risk of much bigger declines. AMP Chief Economist Shane Oliver said Sydney home prices are now falling at their fastest monthly pace since the mid-1980s, after 1.25 percentage points of Reserve Bank interest rate rises since the start of May. This, along with falling real incomes, will act as a drag on consumer spending ahead, he warned recently. Hiking the cash rate to around 3.5%, as expected by the money markets, risks crashing the property market and hence the economy. So, he said, we remain of the view that rates won't get that high. Aside from the impact on home prices and households with home loans, APRA cautioned that commercial property values and loans are also likely to deteriorate under rising rates. Commercial property lending may also be an emerging area of concern for ADIs, with higher interest rates, supply chain difficulties, and post-pandemic changes to ways of working consumer behaviour potentially having a negative impact on values for office and retail sector assets, it said. These drivers may play out in increasing levels of non-performing loans in business lending, including construction. APRA's responsibility is to safeguard financial institutions and their customers from the risk of those banks, insurers or superannuation funds collapsing. They have no explicit responsibility for protecting consumers or safeguarding the economy from risks generated by the banking sector, tasks that primarily fall to ASIC and the Reserve Bank respectively. And with that in mind, APRA assured the Albanese government that it was confident Australia's banks could survive a property downturn and economic slowdown. The banking industry is strong and is well placed to absorb a deterioration in asset quality from housing portfolios or other sources, it argued. While arrears rates are likely to increase as interest rates rise, non-performing loans are currently low and are expected to remain moderate even under a period of stress. APRA will continue actively monitor lending standards and evolving risks in housing markets and review its macroprudential response in consultation with the Council of Financial Regulators agencies. Now, a couple of observations here. The first is we knew the economic situation was deteriorating quite rapidly. Now we're starting to get closer to perhaps a real sense of where it's heading, although probably still too optimistic. Secondly, it's interesting that APRA called out the risks in the housing sector despite publicly hardly talking about it at all. And it's interesting that information was leveraged out under FOI, good for the AFR. And thirdly, the question that I have for APRA and the RBA is how do they know how much risk there is in the system, bearing in mind the fact that the information that is available to them is very fragmented and partial and somewhat belated and out of date. And we know that many households are already struggling, seeing as we've had so many rate rises and more are coming. So I think personally they're looking in the rearview mirror here and they're not seeing things as they currently are or how they will play out. And the kicker in all of this, of course, is that no real wages growth is likely in the next 2 or 3 years. So there is no get out of jail card. And we do expect the RBA to continue to lift rates further, particularly after the Fed lifted 0.75% today, as I covered in my earlier post. So as I said at the start of the show, the economic chickens are now coming home to roost. I guess the question will be, to what extent are households going to be roasted by all of this? And could we see roast chickens? I don't know. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.